Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, September 28th, 2020. I just want to thank everybody for your kind words. I'm still battling with COVID, nothing serious, what I would consider a mild case, but I'm heading into week 3 or 4. Figured probably turn the corner this weekend. Last night was actually one of the better nights, so thank you for all your kind words. Certainly can't say yesterday was one of my better days, but overall days are better than nights and mornings, so that's why I'm not doing a lot of pre-market updates. Kind of just taking it easy, sleeping in, lounge around in the morning, looking at the charts. And then trying to put together videos or posts that are relevant to things that are moving. So here's what I'm going to do in this video. We're going to take a brief look at the stock market, do an update there. I want to touch on the bank stocks. I highlighted those recently. And then the two big stock splits we had recently, Apple and Tesla. So I'm going to go through that. We'll look at the charts of the indexes as well. I want to hit on gold, silver, the US dollar, and euro. Maybe the case shaping up for a bounce there. And then two commodities I want to hit on, natural gas and coffee. And I'll do those relatively quick. All right, starting out with the stock market. So we had the futures were up heading into the open day, so that caused a gap up. I had said Wednesday, or Friday when we closed, we're going to gap up or down on Monday, and we gapped up. And it was interesting. This is a 60-minute chart, so remember where we closed yesterday, or Friday, or I should say hit, was right at that 272.39 level. And then that was resistance, which we gapped above, and we had the next resistance, or really roughly a gap resistance zone there, up to about 275 or so. I have it at 274.92 because that was a target all the way back here. That was T3 before we even started the correction, and then when we hit it right here initially, you got to bounce off that level. So I've just left it at 274.91. But let's zoom in a little bit. I'll go to a 15-minute chart, and you can see you can see the gap a lot more clearly here. I put the line right on the bottom of the gap, which was 274.25, and I'm talking about this gap right here from September 16th. So today, again, futures ramped. We gapped up. There's the opening candle right there today. These are we're on a 15-minute chart now, so you have 4 candles so far. We came back in and hit a low of 274.27. I often talk about that. That was the logical place to enter along. Or if you were trapped in short and we broke resistance, because that is the next buy trigger there. It's bullish, certainly gapping above the both resistance levels. And again, that's right on there. That low was 274.25 as the line shows. They stepped in at 274.27 today, and that's very common. So point is, if you're looking to go long in a pullback, don't wait for 274.25. Why try to capture 2 pennies if the buyers step in early, which they did so far? Nothing big, but you bought that around there. You went in a few cents above there. So far, you bounced about 0.63%. Now, it's pretty simple. That's near-term bullish, and it means the 60-minute divergences are playing out. But here's the levels to watch. Obviously, a move back down below there would have the potential to trigger for a backfill of that support gap area right there. In other words, 274.25. And I also added the latest uptrend line. You have these series of uptrend lines, and when they break, that usually triggers your next pullback there. So this is the uptrend line to watch right now, and it comes in roughly with that support. So depending on what we do today, that would be near-term bearish. Obviously, a break of that would be even more bearish. While if they can hold that level and rally up, then you can use this trend line as well to buy pullbacks too. Who knows how long it's going to last? Remember, bigger picture. Again, a lot of cross currents. I've gone over that ad nauseum in recent weeks, long-term charts, excessive sentiment, but yet we have the strongest and most bullish setup I've seen since the March lows with these big positive divergence, nice clean multi-week divergences that have built and have so far started to play out. Not very much. Again, I said last week that the ranges, these 2% swings in the market are par for the course lately, but the fact we took out 2 resistance levels today, if we can hold above it, then that's near-term bullish. If it fails, it's near-term bearish. That's it. You can look at it this way too. a potential W bottom forming there, when you look at the recent price action in QQQ. And again, the fact that they held that previous reaction low on that second test as of now is bullish, and then you've also broken above that little W pattern there. So that's it. This is either going to prove to be a whipsaw or it's a real deal. Unless it fails, you have to respect it. And other targets I kind of laid out last week, we continue to rally up 280.32 give or take. That's the next resistance slash target level. I'm a little skeptical of of this breakout today. This market's been plagued with whipsaws, and I'm really, bottom line is, I don't think it's time to be aggressively long or short the indexes, but I do these videos for active traders and swing traders alike. And you guys decide whether you want to be in or out of the market, or keeping it light, or going aggressively. IWM, there's a 60-minute chart, bullish divergence like everything else recently popped up. We're at that 149.26 resistance right now, a little bit above it. We're starting to clear it. So a lot like NQ. Today we didn't gap above it, but we took it out after the market opened. The small caps started to run, and while we had a fade in QQQ off the highs, the small caps actually had a nice rally since the open, and that's taken out that resistance level. So bullish if they can hold it. There's a gap right here to contend with. There's the here, I'll give you the line here. There's the bottom of the gap, or at least the high, the reaction high on that candle, and then the top of the gap is somewhere up here. I just have a line at 152.12ish. So as of now, the bullish divergence is playing out. Near-term bullish for the small caps as well. Large caps, SPY, we are now up to, covered these levels last week, resistance at roughly 335.12. Not super well defined, but enough, and it's also the 38.2 Fibonacci retracement level you can see just here on the left of the chart. These fibs, that comes in, the fib line is right just underneath that 335.12 price resistance, with the next fib up there, 50% fib, also lines up with that 340 price resistance. So that's it for SPY. If it can clear this, that's going to be bullish. And if it gets rejected here, you have a gap down below that may need to be backfilled. So that's what you want to watch. And anything much more than a backfill, a gap, would not be super bullish. But again, we've been chopping around lately, and that's the bottom line. And whether we continue to move higher or not depends on many factors. I'm going to give you one other level. Hold on one second here. I should have a price line right here. I see a lot of reaction highs there. So that would be a pretty big level in SPY that I think if that's taken out, we're probably going to just continue on higher. So that's 342.37. And before we move on, to keep it very simple, the two levels to watch on SPY today would be that 335.12ish and the 38 fib just above is resistance, bullish if taken out. Bearish near term if rejected, but then if you are rejected off that level, there's the price support right there. It's 331.18. Let me turn that one up a little bit so we can see the color better. There's that reaction high right there, reaction low right there, a gap and some reactions there. So I think that's those are the levels to watch today. So we're kind of at resistance now with support just below. And if that's taken out, then you have the bottom of the gap, today's gap right there. That would be your next natural resistance level. And you can draw a comparable trend line here on SPY to watch, like the one I gave you on QQQ. And I'm still keeping a close eye on Tesla and Apple. Both of those, market beloved stocks had the stock splits back here in what was it, on the 31st, the last day of August there. And so I have these split boxes, and what they show is all the traders that were trapped, those that bought in on the split, thinking that to be a bullish event, and so far it proved not to be. We had both, you can see the little wedge broke and everything else, sell signals, just like the broad market. And so those are the traders that were trapped. In other words, everybody that bought the day of or the rally after the split right there. And so this is my split box right here, bounded by those orange lines. And so we're still below it. Remember, those traders got into just in the low end of the range. So those that bought either right here, saw those their accounts, at least that position come back to break even briefly, and then Tesla was checked, and we're back below that level. So point is, nothing but bullish if they can take out that, and bearish unless that happens, because again, I think a lot of traders are trapped. I think those can mark significant tops in the market, those splits. And we're still below there, and that's Tesla. Apple, we're not even close. Tesla's getting close, but here's the Apple box. You can see, I don't know if you can make it out in the video, but there's a marker right there for the 4-to-1 split that day on this candle here. So these are, this is where anybody that bought the day of or the rally for the 2 days following the split right there, this is where they were trapped. That's, they need to get back into this box depending on where they bought to break even. And as you can see, Apple still very much below. And so that to me is longer term bearish. Now, intermediate term, as I mentioned, like every other FANG stock out there and every index, we have those 60-minute divergences, positive divergence. And so far, breakout, back test, and moving higher. So, unless that's faded, and for all the reasons I've stated, things happening on the longer term charts and some other things, I think that these rallies, although it's the most bullish setup that I've seen, at least on this 60-minute time frame in many months since the March lows, I suspect it may get sold into. But if you're trading it, sometimes that's, I'll tell you my thoughts where I think things are going, and I'll tell you the only guarantee I'll give you is sometimes I'm going to be wrong. In fact, a lot of times I'll be wrong. So if you're trading it, here's your reaction lows. You just periodically raise your stops. If you bought Apple on the breakout or the back test, at this point, your entry was here or here or a combination thereof. So you have, cost basis somewhere around there. There's a reaction low. You can set a stop there. You can also put a trend line here like you have on QQQ and SPY and set a more aggressive stop on I would wait for a 60-minute close or a very impulsive break of that, but a 60-minute candle, because sometimes you get those whipsaw moves through a trend line, meaning intra-period it'll break down only to close back above the trend line with a 60-minute candle close. So that would be, again, those are various levels to stop out. And something else to watch for Apple is this trend line. Remember, we had a trend line off these March lows, and we're coming up on it now. We're a little ways to get there, but watch what happens if we back test that. Look for rejection there, and that could trigger the next leg down. Okay, a couple weeks back, I started pointing out some bearish developments in the banking sector, and of course, very important part. It doesn't have the weighting in the index as the tech sector does, but if the banks are in trouble, then the economy and the stock market's in trouble. It's usually how it goes. And so we had a clear breakdown. There was a uptrend line, formed a symmetrical triangle. We broke to the downside, and then we also took out that horizontal support about 73.64, and we hit that support zone that I gave you, I think, last week here. It's roughly 69 to 69.50, and that's, you can see the previous reaction lows here, reactions there, a gap, a lot of reactions along that level, and so that was the logical place for the bank stocks to bounce, and which they did. Now, but look where they bounced to. We're coming up on that 73.64ish. That is resistance. Support once broken becomes resistance. If the banks can power through there, then they have a back test of the trend line, actually dual intersecting trend lines, uptrend and downtrend lines. So here's what we want to watch for the banks. A rejection there, if that happens, probably take us back down to the trading range, although there is a gap to be filled if you look in today's gap, that is. So that's also a logical support level if the gap is backfilled. So what I'm going to show you are potentially bearish events. If we go down there and move much below the bottom of today's gap, then that's probably going to take us down to the bottom of the range. Obviously, a break of there would be quite bearish, whereas if we can hold above here, rally up, take out 73.64, well, that's going to be bullish. There's a gap right there to contend with as well. So it's not all smooth sailing, but I'm showing you the levels that if we get some traction with this rally, if those 60-minute divergences are going to play out more, look for very significant resistance if the bank stocks happen to get up here. And this again is BKX, the KBW Bank Sector Index ETF. You can look at all the big banks and you'll see something similar with the I'll pull up XLF. and just hit on a few banks. JP Morgan, Chase. There's a same reaction low from right here. Put a line there. We almost hit it, but again, the sector itself hit. But back to resistance right now. Berkshire, not really a bank. Bank America certainly is a bank. And there's that reaction low back there, well above it right now, kind of in no man's land between support and resistance. Wells Fargo, better, one of the better looking charts of all the banks. If I was bullish on the banks, this is certainly one that I would consider going long. You have a trend line here. I had a little whipsaw through it recently, but I still think it's valid if taken out. Could be the catalyst for a move to 26.44. That's a big level. We've been consolidating in that range for a long time. So, you know, it's the same story. If the banks take another leg down, take out the recent lows, that's not going to be good. But if we can break above that, I don't see a whole lot of resistance. There's, of course, a few stopping points along the way, but that'd bring Wells Fargo all the way up there at about 33.78. Okay, moving on to the precious metals, gold, silver, US dollar, and we'll look at the euro just real quick. Very near-term stuff, leaning towards a bounce in the in gold and silver here. You put in a divergent low recently on the 60-minute chart. We're looking at GC, by the way, guys. Gold futures, there's a symbol right there, GC. This chart shows a little better than GLD. I know some of you don't trade the futures, but you can kind of extrapolate these levels when you pull a chart of GLD. Look for the reaction lows. Now the thing is, gold trades almost around the clock, the gold futures that is, and so you're going to have different additional candles and reaction points and trend lines and things you can't pick up on GLD. But most of these major reactions you probably will align with you know, reaction points on GLD. So what I'm looking at here, again, positive divergence. We had downtrend line here. We recently broke out, back tested, and we haven't taken off yet. So I think if you zoom in a little bit there, it looks to me if we can take out there are about 3 highs right here. If we can pop those, that's going to bring us up here at least that 1911 level in gold. It's a pretty significant level. It's just a near-term target. You know, for active traders, it might not be worth it. For a swing trader, it's not a whole lot, and you know, percentage moves, that would only be about, you know, 1.6%. Plenty of money to be made on, you know, gold futures because they're leveraged. Then 1951 is resistance as well, and it could be more. Again, if that 60-minute divergence plays out, there's a potential for more. Silver. Let me go down to a 60-minute chart here. And let me flip over, get off these candles that are not working well recently on this charting platform. And there it is. There's your divergence right there. Positive divergence like you had in gold in this recent low, and it's moving higher. If it can recover this level here, about 23.60, 67 or so, it could run. How far? Hard to say, but I can, yeah, there's certainly a reaction low right, some reactions, I should say, right around here. It's not super well defined, but I'm going to give you a level there, an initial target that would probably jive with that first target I just gave you in gold. And then up here, this is a big level here, 26.22. That's where silver had traded for a while in the sideways range. It had support there for quite some time, and when that level broke, there was just a waterfall drop with a little kickback rally there, a little not really textbook flagging action, but for all intents and purposes, you had the same thing. You had an impulsive leg down, followed by an area of consolidation, followed by one more thrust down. So that's that. So there's your potential bounce targets, and that's a big one right there. I think if we get back there, that would probably be the end of the run in silver. If we do, how much would it be? I have to grab a little bit below where we are now, just because I'll move that trend line otherwise. And I would say that's about 11, better than 11%. Or so if it gets up to there. Okay, and part of the reason for, you know, a possible bounce, other than the technicals I just showed you, is the dollar. This is the U.S. dollar index, or dollar futures, I mean DX. We're looking also at a 60-minute chart. And highlighted last week this bearish rising wedge pattern right there, which we had a breakdown and a back test, and we've been moving lower. And based on the negative divergences, that would indicate a little more downside in the dollar, probably to this zone here. It was a resistance zone, which we broke out, and it gave us, and it gave us a buy signal there. But at this point in time, Looks like, and same thing with gold. I give you those 3 reaction highs. You can see these 3 reaction lows. So if we can get a little more downside in the dollar, which I think we will, we'll probably come in and back test that breakout point and then resume the rally up to about that 95, 675 level, assuming we just pull back and back test the breakout, which is right now my scenario. So it kind of meshes with gold, just a at least very near-term drop in the dollar, bounce in gold and silver, and then we can also look at the euro. The euro is the biggest component of the U.S. dollar index, makes up I think 57.6% of the dollar index, if I'm not mistaken. And so, looking at the euro is basically an inverse of the dollar. And so, when the euro rallies, that means the dollar is falling, and so a rising euro is bullish for gold. And so, what you can see here on the euro is the same thing, positive divergence right there on this 60-minute chart. Not the best support level, but either way, if the divergences play out, in the same thing, I'm looking only for a relatively small rally. The 60-minute divergences could indicate more, but at least to this level here, we'll call it a resistance zone. It's about 117.35 to 117.55. That'd be the minimum bounce target there. If we got it, it should be net bullish for gold and silver. And should we get more than that, if we take that level out, then here's a potential max target. Let's say at 118.97. And obviously that would mesh more with that bigger rally in silver and in gold as well, to those higher targets if we get that. Okay, updated coffee last week. I think it was Thursday. Coffee hit that third and potential third and final target there. To the button again, covered quite a bit last week. Set up with this bearish rising wedge and broke down and had a heck of a correction so far. And we reversed just shy of what was the first target back here around 32.77. That's the actual the target level. The line's at 32.84. We reversed a little shy of what we started to rally. We're getting checked today. Coffee's pulling back. Maybe a normal pullback. Remember, coffee is pretty volatile, so a 3% move, you can just eyeball a chart and you can see the size of the candles, and that'll give you an idea how volatile something is. So this is just nothing big so far. Now, I should point this out. I don't think it's going to happen, but it's certainly worth pointing out that was an impulsive move down. That may be flagging action, bear flagging. And if so, it would project for a move all the way down here. So like any other trade, you don't get married to it. If it doesn't work out, you don't ride this out long all the way down there, because that's again roughly the measured target, the distance of the flagpole added to the top of the flag there. Now what I think is probably going to happen, I do like coffee. Took a position in that last week. If we do get another thrust down, we may come in and fully tag this support level before moving up. And let's look at coffee futures. Those are KC as the contract, of the symbol for the futures contract. There it is. We had that same thing. Big bearish rising wedge when we hit T3 right here, broke down. That was your chance, if you didn't already get out, T3 to get out on that sell signal. And then we came full circle. We set up with a little steep bullish falling wedge. This was a bearish rising wedge. There's a bullish falling wedge. And very nice support right here, about 108.60. And we reversed just shy of it so far. So just like JO, the coffee ETN, yeah, I could see another jog down to either hit it or just a slight run through. Often the securities like to do that. The market makers, the games that the people play, run the stops, shake out the longs, and then reverse. So bottom line is I'm still bullish right now on coffee, and I think a stop somewhat down below that level. It's an objective long on a pullback to that 108.60 or just above it, with a stop somewhat below, maybe even on a daily closing basis, because coffee tends to be whippy, and it wouldn't surprise me to see a little punch down through there only to reverse. And if it did, look, we're going to still have these divergences still very much in place. So again, that would be the scenario of a marginal new low like that. It would take the PPO down a little bit and reverse and extend these bullish divergences that we already had in place at this when the wedge broke out. And I shared, objective entry points and stops. As far as price targets go, I'd let coffee run. See if it can run up to these next levels and possibly beyond. I'm still longer term bullish on coffee. Let's see if I have my long term chart. Yeah, here we go. Yeah, this is the weekly chart of coffee. So we're looking long term. Let me color up this tool. And this is it. Again, weekly chart, bigger picture, multi-year divergences. Imagine this is an arrow tool, but just a line tool. There was our divergent low, just like we had a divergent low here before that 126% rally, like we had a divergent low here before at this point through about a 300% rally, and before all said and done, we went all the way up here to about a 627% rally. So those are the things I look for. These big trend trades on a weekly chart. These are trend trades or investment, positive or bullish divergence, and I look for these divergent highs to signal corrections, just like that divergent high there, that divergent high there, and this divergent low. So way back here, I've laid out a few price targets, and we already hit that first one way back when, right here, 60% rally off that divergent low. Might have been a little bit more. Yeah, it was 61 because I laid those targets out before we broke out of this little wedge, and so I think this is what we're looking at. Bigger picture here is first thrust up, corrective wave, and the next thrust up should take us up to that target again, 90% give or take from back here. Yeah, based on everything again on this long-term chart. And when you zoom down to the daily chart, this is also coffee futures, the continuous contract. Stock charts uses the symbol $COFFEE, whereas we're looking at KC, which is that's what the trading symbol is. Little wash, rinse, repeat stuff. Look for these little divergent lows, 1, 2, 3, 4. Right there, and you get these, and then divergences, I always say, are not the buy signal. It's a break above a trend line. So boom, there's your buy signal, rally, buy signal, rally, buy signal, came and back tested the breakout. Oh, actually no, this is where our divergent low was at this point right here, rally, divergent low, trend line breakout, rally. And is it over? Is it one and done? Maybe. I don't think so. I'm leaning towards, as I told you before, another thrust up. What I can tell you with certainty is look what's going on coffee. Boom, boom, boom. Making right now so far a series of higher lows. If we can get another thrust up and put in a new high up here, we'd also have a series of higher highs, and we we certainly currently have the makings of an uptrend. Again, we just need to take out this high, or really this previous high over here. Okay, and last but not least, natural gas. We're looking at a long-term, a weekly chart of nat gas. These are nat gas continuous contract, the futures. And this is one that I shared a few months or a month or so ago. I put cycle lines at that point in time. Notice that there was a period of seasonality, if you will, around this time of year or that time of year, where there was the blue lines right here. They're set 52 weeks apart, and especially when confirmed in these cases when you're coming off a divergent low like you were back here, positive divergence, and then you hit that point, there's usually more upside. And so far that was the case. That was a cycle line right there. There was our divergent low, and it's been a nice rally. We had a correction along the way, but I think there's more. After a divergent low like this, usually you're going to get another leg up. I think this is the first corrective wave in nat gas. Let me show you the nat gas futures shorter term chart. Let me find the 60-minute chart for you over here. Okay, so this is NG. That chart from stockcharts.com, they only give you end-of-day data, so it was through yesterday's close. This is a live chart here. Let me color up the line again. All right, so here's what stands out. There's on this 60-minute chart right here, you can see positive divergence right there. Put in divergent low, equal low right there, and we had a rip up. This right here, let me get those lines cleared out, is looking somewhat like a potential inverse head and shoulders bottoming pattern. So you'd have right here, this is your left shoulder. There's your head. Sometimes you have what they call double head. You have two lows. It doesn't matter. It's the same difference. And then a right shoulder there. Nice symmetry on the shoulders. In other words, that right shoulder pulled back to where the left shoulder was, and so that would be your neckline. And those shoulder points right there, I have a line at 2708. It is price support, so I can say this: that's an objective level to go long. We're a little bit above it now, but it's not too late. Put a stop just below because that's your previous reaction. We had a reaction today. That's another reason that level should hold. There was a gap back here, and there's some reactions there, but I'm most concerned with this most recent price action. So that's what that would look like. So expect a rally up here. Let me give you that neckline because that's going to be resistance, or it should come in as resistance. Also potential near-term target about 2915, and there's also a potential downtrend line. I had to take some liberties. There's a couple chops through it there. Maybe I'll just lift that up if depending on if and when we get there and we have a reaction. It might come in right here. That would fit a little bit better. That's it. So I'm taking the view that we've had a initial leg up, found that divergent low, and a correction, which is normal, and that gas is about to take the next leg up. Okay, and for those of you that prefer ETNs or ETFs over futures, UNG is probably your best bet. It's not using leverage. The leverage ones blew up earlier where they were taken off the market. They're trading on the secondary or over-the-counter markets now. But UNG, look, natural gas is volatile enough. You really don't need 3-time leverage when you trade it. And if you're going to trade the futures, it comes with a bunch of leverage anyways. By the way, NG are the futures I just showed you. There's also the mini contract on is I think Q, if I'm not mistaken, double check it, QG, and that's the trades off the same price levels as NG. You just have a smaller leverage factor, so that might fit the bill for some of you that want to go with the futures. And if not, UNG, here's the levels to watch. This is a daily chart, 1310. We already hit that level once. That was a target before. Yeah, right there, and that would be the next target as well. See, we don't have, actually we do almost have that inverse head and shoulders here. It's not as clear. It comes in a little bit different, that reaction high, because again, what you're not seeing on UNG are the round-the-clock trades that you do on NG. So whereas NG that night probably went up here, that's your breakout point. You can go long here at the bottom of right shoulder. It's just like when I trade a potential head and shoulders topping pattern, on a stock or a security. If it's like this, the textbooks say wait for the pattern to form, and then your buy signal or sell signal is on a breakdown below the neckline. Whereas I'll often, if I anticipate that's what the pattern will be, is if you have, if the pattern looks pretty, everything's confirming, you had a high volume drop off the top of the head, sometimes I'll put a short entry there at the top of the right shoulder with a stop somewhat above, in case it's foiled. If we go up a lot higher and there's no more symmetry, then you don't have your head and shoulders. Same thing with an inverse head and shoulders pattern. So again, the point is, like I showed you earlier, you can, if that's what it's going to prove to be, you can take either a full or a starter position here with a stop somewhat below. And if you took a partial position, you wait for a breakout above the neckline, in this case roughly 1310, and at that point a target, well, this is a longer term target I had before. We fell just shy of it. It was around 15. But again, these are, UNG does a good job, but not a perfect job of tracking the futures. So my advice is, if you are going to trade UNG, keep an eye on the futures. If you don't have a futures account, investing.com will give you free real-time futures charts and quotes, so you can mimic the NG charts on investing.com. And that is it. We're going to wrap it up here, and I don't know if I see anything else that stands out, I'll let you know. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.